Welcome everybody to Angel NV. I believe this is our fourth week, starting back in October. We're gonna run our founder boot camp from now, or from October 12th, through about the third week in January. Every week, we're addressing a different topic that answers the basic question. So what do angel investors want? How do I get my company funded? This week, we're talking about due diligence. And my partner in FundNV, Bill Slikkerveer, is going to be doing the presentation. So I'm going to tell you a little bit about Startup NV to get started, and then I'm going to turn it over to Maggie, who will act as MC for the rest of the evening. So first, I'd like to thank our sponsors, Brex Card. If you are a founder and you're looking for some credit for your startup and you don't want to put your personal credit on the line, Brex is a great place to look. If you follow the link that you see on your screen there, brex.com followed by us, Startup NV, you can apply and get a Brex card, and for on top of whatever credit line they might give you, that's not backed by a personal credit, you'll get a $500 drop into your account. So if you do intend to do something like that, I suggest that you start by checking out the Brex card folks. The City of Las Vegas is one of our most generous sponsors, giving us lots of space here in our operation in Las Vegas, space to do our events, space for our offices in the Las Vegas area, and super supportive of the startup ecosystem in Las Vegas. So for those of you who are joining us from Las Vegas, when you do get a chance to thank the folks from the City of Las Vegas, please do so. And finally, our friends at Glassboard Technology. Glassboard Technology provides the technology that we use as an investor group to allow our investors to join the fund and make the ultimate investment that's going to come at the end of this particular program, where we as a group will invest $200,000 in at least one company. Last year, we ended up collecting $330,000 and investing in 3 companies. So at the very least, we expect to have 40 investors investing $5,000 each in a fund, adding to $200,000 that will eventually be invested in one of the companies that applies to us. And if we raise more than $200,000, then that additional money will be invested in additional companies. So thanks again to Glassboard Technologies for providing the technology that sits behind Angel NV. So about Startup NV, we help companies that startup companies from the time that they have the idea all the way through to the time that they're generating revenue and starting to scale. Our incubator program, known as Grow NV, addresses companies that are in the feasibility stage, basically from the time that you have the idea through the time that you've developed your first MVP, your minimally viable product. Some people would call that a prototype or a version 1. And that's what Grow NV helps founders with. From the time that you get to that point where you've actually got a product in the market, that's where our accelerator program, Startup NV, kicks in with a possible $50,000 investment in your startup. And we kind of help you ending that phase of getting your MVP and your beta live, all the way through product launch, getting your first set of customers with market validation, and getting into the early stages of revenue generation, generally up into about $500,000 a year in annualized revenue, at which time you're ready for your seed round, which we help you to address not only with continuing in the accelerator program, but with our newest fund, Seed NV, which makes those larger investments in those early stage companies. So we ultimately have 6 programs, Grow NV and Startup NV, which I just talked about for entrepreneurs. Angel NV Bootcamp, which you're all in right now, answering that question about how do I attract angel investors. If you happen to be on the investor side, you can join the Angel NV fund that's going to invest in one of the companies that applies, perhaps one of the companies that's here on this call tonight, perhaps a company that'll come in later, but of all the companies that participate in Angel NV, one of those companies is going to get an investment from, hopefully, some of the investors that are on this call. Our FundNV, which is the fund that invests the $50,000 in our accelerator program. So investors can join that fund for an investment of $10,000, all of which adds together, and we make 20 $50,000 investments for a total of $1 million in 20 different startups. We have invested in 8 of those companies so far, so there's still 12 to go. We expect to have those companies found and invested in probably by the middle to about this time next year, investing in 1 or 2 companies every quarter. And then finally, Seed NV, which is our seed fund that does follow-on investing in the companies that have been invested by the Angel NV group and by the FundNV group, as well as general community, general seed level startups out there in the community. So does this work? Has this ever happened before, or is Jeff just talking about fantasy land? So we've actually heard about 696 pitches already. We actually do keep track of it. We've invited 53 companies into the accelerator. 29 of them have made it through due diligence and been funded. And between our investments and the investments that we've made in conjunction with partners, we've raised about $71.2 million for the companies that have come through the fund or through Startup NV. So it works. There are 29 companies out there in Nevada somewhere that have garnered over $70 million. So it does work. And who are some of those companies? Well, here's 8 of them that are in the program at the moment. So, so they're great examples of companies that have come through the program. And I'll call out one, Safe Arbor, who's the company that won this very program, Angel NV, last year, and received an investment from Angel NV of $220,000 and an additional investment from FundNV of $50,000. So it does work. So carry on, all of you folks who are in there wondering, how do I get angel investing? This program leads to it, as well as the program that we have through Startup NV. So I will turn it over to Maggie now to take us through the introduction to Bill, and then Bill will tell you all about due diligence. It's a part of the fundraising process that can be a little bit painful if you're not ready for it. So listen hard to Bill. He's going to make sure you're ready. Hopefully you'll take his advice and be ready to for due diligence, whether it's for us at Startup NV, our group at Angel NV, or wherever it is that you might go to raise your money. So thanks everybody again for coming out tonight. And Maggie, over to you.
Well, hi everybody, thanks for coming. I'm in the big group photo here. And Bill is to my right, and he's got his video turned on. Bill is a longtime airline pilot. And while he was doing that, he was also a major negotiator for the Airline Pilots Association Union. And he has tremendous attention to detail, which is exactly what you want when you have somebody flying a big tin can in the air. But he brings that into his analysis of financials when FundNV or Angel NV is getting ready to make an investment. And you can't get much past Bill. So Bill is the perfect person to go over what you need to work on to be ready for that due diligence of an investment. Take it away, Bill.
Okay. So good evening and welcome. I will try my best not to go too fast. There's quite a bit of information in here. Share the slide and set it up in the presentation mode. So the title itself, tonight I'm going to try to focus as much as possible just on the financial aspects of due diligence. There's quite a bit that encompasses due diligence, but I'm going to try to focus on things that you should watch out for as founders and at the same time that investors are looking for. Due diligence by itself, as the second title says, the devil's in the details. It becomes somewhat of a forensic exercise when you're doing due diligence because the more questions you ask, they lead to other questions. So the more prepared you are as founders in how you've structured your business, how you've gone through making decisions, the better off you'll be when it comes time to actually go through this process. So the general due diligence path is one of gathering information, and the typical way it's done is with a checklist. And I'll show you some of those checklists if I'm able to at the very end here, but at least they'll be attached at the end of the slide presentation. The end of the day, a diligence process is risk assessment. The investor is trying to figure out whether or not, after analyzing the key areas, is there a thesis for investment? Does it make sense? And then if they say yes, then they'll engage you and you'll be discussing what kind of deal terms that might entail. And my understanding is there'll be a further presentation that will get into the area of deal terms and term sheets and things of that issue. So the key areas that I'm focusing on tonight, although there are more, is the technical, the market, product development, and financial. Three that I'm not specifically mentioning are the team, which they would look at. In particular, investors look at how many founders, because depending upon if it's one founder, it's how much do you really know. If there's more founders, then you tend to complement each other. If you know something about a particular area, say marketing, and the other is more business focused, or they're more technically focused. And then another area is IP, or intellectual property. And most people just look at it. I know this isn't up on the slide, but I just wanted to cover it real quick. The intellectual property covers more than just patents. It would cover things like copyright, trademark, and also trade secrets. And legal, of course, is always there. And one thing I would bring to your attention, because it's come up quite a bit in the last couple of diligence process I've been through, is how you form your company, whether it's as an LLC or as a direct corporation. If you start as an LLC and then you convert, you really need to pay attention on how you do that, because there's some pitfalls. But again, I think those will be covered in another presentation. So when we're looking at the technical risk, some of the areas that are key, when you're looking at your product and whatever it is that you're selling in your company, if say it's software, you're going to have some kind of a development roadmap. Without it, you could spend an awful lot of money trying to create something. And if you don't really have a method to your madness, you could basically just run out of money. The other side of the technical risk is, what kind of product is it? Is it software? Is it hardware? Is it a combination of both? Is it a marketplace? Marketplace concepts, where you basically have two ends, of the market, where you have to figure out, how to develop that marketplace. It's kind of, and I'll discuss it more further on here. It's a little bit of the chicken or the egg. Which side do you develop first? But it's a risk, and you can spend a lot of money trying to develop a marketplace through marketing and go-to-market processes that are ineffective. On the development team, this is another important piece, because if you don't have the technical expertise as a founder on your team, then how are you going to develop it? Let's call it software. If you don't have it on your team, you either have to hire someone, which in an early stage is difficult to do because typically there's not a lot of funding to do that. Then you have to look at outside, and it could be domestic or foreign. And domestic tends to be more expensive than foreign, as an example. And I'll cover that some more. Let's see. Next is the market risk. So some of the things here you have to pay attention to is, how you're going to sell to your customer. And I differentiate the top down or bottom up. Top down tends to be more sales driven. Means you're going to spend more time, more money trying to drive the sale of your product, after your marketing has developed the leads. Bottom up is more a word of mouth, kind of process, similar to what Dropbox did. And if any of you have ever heard of Superhuman, they're an email program that's out there where they just basically created a landing page and nothing else. Enter your email and they got back to you. So pricing, how did you develop it? It's very important. It stems right out, from the market. It really ties back to the customer, how much you've really discussed with them, and will the market support it? And within the market strategy, you have to look at, your go-to-market. And there's all kinds of different ways to do that in channels. And you want to be cost effective in how you do it. You can spend an enormous amount of money trying to develop your market. So you have to be really on top of it and do your research. And I believe, I guess this last week, you guys covered the TAM, SAM, SOM, so I won't go into that. But from a financial perspective, it's really important how it was developed. Does it stand up to scrutiny? And what I view as pretty important, does that obtainable market, can you tie that back to your financials, your projections? Does it make sense? And then, of course, there's customer metrics they want to look at. These are all numbers that initially you're going to perhaps try to estimate, but as you get further along and you're actually generating revenue, they become very important. The the CAC, customer acquisition cost, the long-term value of a customer, and then also whatever's going on called churn with your product. In other words, the turnover. Another term you'll also hear that I didn't put on the slide is called KPI, which is key performance indicators. Again, they could be something financial, they could be user growth, they could be the time that the user's using the product, how they're using the product. But you should have an idea of what you're trying to measure before you launch your product. Because otherwise you're just throwing it out there and you haven't got a clue what you want to see. And if you're not measuring it, you're gonna drift along for a while till you figure out whether your product is actually gaining traction or not. So on the product development risk side, one of the issues with a hardware product or any product, call it called deodorant product or something like that. You have to produce that product. You have to have the money in order to launch it, create inventory, in other words. So it's another expense. Theoretically, the software side of it, it's kind of the same thing, but it's already built into the product because you've spent it. But when it comes to a combination between software and hardware, you then have to account for that ability to launch that hardware piece and have the funds to do so, inventory, in other words. And if you don't do that, you're going to find yourself in a position where you're ready to go, but you're not able to produce it because you don't have enough funding. If you think about these things in advance, then you can plan for it. And I covered a little bit earlier about the software development, the in or out of house. One concept that's out there, and it's been there for a while. If you're doing it out of house, if you don't have the technical expertise, you can find venture firms that have the ability to help develop the product on the software side, and they will do it for a combination of cash and equity in the business. Typically, somewhere around a 50-50 is what I've seen. Now, the issue again with software development out of house is you have to manage that. You really have to stay on top of it because it can get away from you. This is where costs can go sky high. Typically, software development, the amount of time and money to develop is underestimated. Jeff likes to say that if somebody gives you an estimate for time on a software development, multiply it by 2 to 3, for reality, as a reality check. One other part that I tend to see a lot is trying to put too many features in the initial product on this is software again. You're not paying attention to what the market really wants. You haven't gone to the customer and really understood. You're building something that you think they want, but they may or may not. That's why, I like to say that before you even begin coding one line, you've gone through all of the effort at the customer level to make darn sure that this is something they want and that the market will support, and that you haven't got some kind of competitive risk out there where somebody else has already done it and done it in either a better way or a different way. So, and the last point here again is the cost versus the value versus the timing of these features. That brings back in that roadmap that I was talking about earlier. So on to some of the, some of the true financial risks where I, as an investor, take a look at somebody's financials, let's say their current financials, their balance sheet, P&L or profit and loss, cash flow statements. One thing I want to know right away is, what is their cash position? How much cash is on hand? How much are they burning? In other words, how much are they spending every month? And how long will that last? Because that gives me an idea of, just how urgent is their funding needs. And one area I found that stands out quite a bit also is the expense categories. You can find anomalies pretty quick when you start looking at either the projections or the current financials. You can get a pretty darn good idea of where the spend is, and that's where all the questions start. Is there anything unusual in there? Always know and understand what's in your financials. Have them at the tip of your finger. You should always know what your cash position is. You should always know how much you're burning. If you don't, when an investor asks you, it's kind of a black mark if you can't basically have it at the tip of your fingers. Another thing that I look for pretty heavily within current financials is, what kind of debt is already there. There doesn't always tend to be debt. It depends on how long or how ongoing, the business is. There could be some early stages, you tend not to see it. One thing that I have seen lately is that some founders, when they're funding their own, doing their own funding, putting in their own money, is how they structure that particular funding. Some do it as debt, as a note. You could do it as a convertible note. One thing that I think makes sense for founders today that I've seen is, when you have funding like that, it's probably a good idea to actually structure it as either a convertible note or a SAFE, a simple agreement for future equity, only because if and when those convert, that conversion effectively is a one-time pass to reduce your dilution on that first conversion. Won't affect the future ones, but it affects that one. And it puts you on the same playing field, more or less, as the investors themselves. So you get treated the same, and why shouldn't you? So one area that is really key in the financial projections is the assumptions. I look very heavily at them to determine whether they make sense. I look at margins, if it's a product business, cost of goods sold, things of that nature. I've seen some things where cost of goods sold went down by 20% over a 3-year projection, which made no sense at all. In fact, it wasn't correct. So be very careful when you're putting together your financial projections. Put some time into it, really think about what you're trying to get across, and it should be tied to a product roadmap. It should be tied to milestones. It should have a rational progression in there. I think anything beyond 2 years, kind of turns into pie in the sky. I like 1 to 2 years, or not 1 to 2, about 2 years. If it's a initial startup, if you've been ongoing for a couple of years, yeah, then 3 years makes sense because you have some basis that you've started with. Yes, ma'am.
So
I think we have some
if
questions.
it was ongoing, you could have a longer
Correct.
series of numbers to look at. But if you're referring to a company that's still in the ideation stage, so they only have projections at that point.
Correct. Yeah.
Okay, so how diligent do they have to be at that very early stage? Does it just have to make sense? They have to be able to rationalize how they got there?
Yeah, that's pretty much it. It requires them to have thought out at least what they think they're going to do with their product roadmap. They have to be able to tie it back to a roadmap. So it's some kind of development process or marketing process they want to incorporate.
Okay, so it's going to be pretty easy for them to have expenses and know what future development is going to cost based on current development. How are they supposed to guess at what their sales are going to be?
Well, that's where they come back into their obtainable market and what they said they thought they could do. That's where the assumptions come in. You know, it's there. Some of it, you know, you can garner from, you know, what's ongoing in the marketplace already. Is there another product out there? What have they done? You know, if it's something new, well, it's a guess. It's going to be a guess. You no other way to do it until you're 6 months or a year into it to see what really happens. And typically on a startup with no revenue, you're going to be probably experimenting as to what's going on with pricing anyway. You're not really sure what you can sell it for. You did your best with your research and with your customers, but you still don't know until you get into it.
And so the same fellow asked, do investors buy into assumptions? Be brutally honest.
So investors, depends on how reasonable they are. I mean, it depends on whether they make any sense. You know, if they're not tied to some kind of rationale, you know, then probably not.
But it also depends on what the product is.
It does.
If it's just another app and there are already apps out there already doing the stuff, you're not going to get an investor. No matter how conservative your assumptions are, it's just too hard to rise above everybody else that's out there. So you're taking the risk, investors won't.
Right. So to finish up the last two pieces here, and there's another slide day on this one. You know, we discussed about the reasonableness, but some of the things I look for are just numbers that are out of line. Like in the early stages, even with revenue, if there's large numbers in there that just skew the expenses or the ability to reach either a break even, you know, or keep within a certain loss as they eat up their funding, because that funding feeds into it as a cash position. So I look for, you know, something that's out of the ordinary. It just doesn't make sense. And you'll know it when you see it. It just sticks out. Sometimes, you know, it could be, you know, large numbers for travel expenses. I've seen that, or, you know, it's all myriad of different things. So the other side, you know, when you're looking at projections, you know, is the revenue model. What kind of revenue model is it? You know, SaaS, which I'm assuming you're familiar with that term. Software as a service. And then, you know, is it transactional? You know, it's just a, you know, buy and sell transaction, credit card transaction, let's say. Or there could be a license in here as well. Those are different models. But what I'm interested in is, does it tie back to your market? Does it tie back to that obtainable market? Is there a flow from that market to that revenue model that makes sense? So let me see here. Oh, one other thing I wanted to mention, when I'm looking at some of the debt, for instance, if there's a convertible note there, I like to look at the note to see, you know, what's the structure of that note. I have seen some convertible notes with an interest rate as high as 20%, which is frankly pretty outrageous. It's too high, frankly. So you should have a general idea of what kind of convertible note terms are reasonable, and that runs in terms of duration somewhere between 2 to 3 years, an interest rate between say 4 and 12%. It'll have some kind of value cap, which is valuation, meaning you've determined what you think your company's worth, and that's an agreement. It's a meeting of the minds like real estate between you and the investor as to what that is. And that valuation cap, these are terms that you'll run into, I'm assuming a little bit later, but it determines how the investor is treated when that note converts. One thing to point out is that a safe avoids a lot of the problems of convertible notes. You know, what FundNV is starting to do is we've moved pretty much completely to safes now, because it avoids a lot of different problems.
Like what?
Well, the interest and how it's dealt with. If it's not dealt with properly by the corporation, if they hold the note, they could declare it improperly and then create a taxable event for the investor, is one. The other side is you got to deal with valuation caps and the conversion. It takes out a lot of the mechanism that a convertible note has to go through. It's math at the end of the day, but it's just easier. You literally, with a safe, you will know what percentage of the company you're giving up right away. A convertible note, you will not. You will not know until that next conversion event takes place. You won't know what percentage of the company you have given up and diluted in your ownership. So one last page on more financial diligence, and this is a very important one. It's the valuations. You think your company is worth X, an investor comes in, he thinks it's worth Y, and somewhere between you guys have to meet and agree if there's going to be a deal made and some kind of funding. So methodology is pretty important. It could be anything from, let's say you're an ongoing concern and you've got some solid revenues. It could be a multiple of revenues. It could be a multiple of your what they call EBITDA, earnings before interest, taxes, depreciation. And there's other methodologies, and they could take into account, what kind of traction you've been getting, what kind of user growth. There's all kinds of things that can figure in there. Now, I will tell you at the end of the day, when it comes down to basic, your venture capital folks, if they are interested in your company and it's solid and it's got some good standing, they will look at it and say, I want to own a certain percentage. For instance, seed venture folks, they want to own 15% upfront. That's their target, because they're basing their earnings, their ability to return money to their investors on a certain ownership. So to get to 15%, you got to have a certain valuation, and then it's kind of driven by how much you want to give up. So that it then just becomes not so much a mathematical calculation as just how much am I giving up? Am I willing to take that dilution? And what kind of valuation does it take to get the investor happy? Truly, sometimes that is how it works. Now, they will go through some of the other underlying methodologies, but in the end, it's probably how it's going to work. One other thing that is important, which ties back to your financials, is projected funding in the future. You're going to get your company growing to a certain point, and then you're going to run out of money, or meaning you have to pursue some more funding. So somewhere in there, they're going to want to see, where do you think you're going to need more money? What does that next valuation point look like? And they're going to bounce it against a general rule. And that rule is that, for each subsequent funding round, that's somewhere between 2 to 3 times your prior round's valuation. That's what that next round looks like. So if you started out with a 2 million valuation and you're seeking funding, they're going to look to see, okay, does this business support, a $4 to say $6 million valuation? That's a general rule of thumb. It doesn't always have to be that way, but in general, that's how they look at it. And then when I look at prior rounds, I want to know on what terms those were done. Were they more favorable to the investor, or were they balanced to the founder and the investor? That's why I mentioned that 20% interest rate. That was clearly not in the founder's best interests. That's why it behooves you to really understand and do the research on terms in a deal. And there's a lot of them. They're not all financial. The main issue, the star of the show when investors come in, is the cap table, the capitalization table. It's the ownership structure of the company. who owns it, how many of them are there, and who owns it, how many of them are there. You know, if you've got too many on the cap table, it becomes something that at the venture level, they get a little nervous about because they don't want to deal with all those people. They want to see you know, pretty much a clean capitalization table. So one way to get around that is, you know, when you're thinking about future rounds, and let's say you've got 20 people interested, but each of them can only put in, let's say, 5 to 10,000. You can scoop them all up into what is called an SPV, which is a special purpose vehicle. Really easy to do today. It's just a legal entity that represents all of those people, but ends up as one line on your cap table. I have seen as many as 30 to 40 investors on a cap table. And for the founder and for future investors, it just becomes a bit of a management issue. That's a lot of voices they have to deal with. And at the venture level, they just don't want to. They will ask you to do something with it. So it behooves you to try to keep it as clean as possible. One other thing I have seen is a lot of companies have advisors. It's probably one of the best way to get not free advice, but you have people who can give you advice on areas that you don't have expertise. However, what I've seen is that one, they're not always well documented. And they could have been run through that other term I have up here, which is an option pool. If you're gonna, at some point, you will have to create an option pool if you haven't already. It will be required at the venture level because that's your way of paying future employees. It's the standard Wall Street method of paying future executives through through an option program. That's why you do them. The size of it is anywhere from 10 to 15% of your capitalization structure. One other thing I have seen on ownership is there's investments made to the corporation, but they're not documented. In other words, they're on the cap table, the money's been taken, but they haven't been properly documented. Stay on top of the documentation. It is a black eye. When I see something that hasn't been documented properly, it's just not an attention to detail. Just remember, it's a forensic exercise that they go through. And if you eliminate a lot of the things that can taint how they're looking at your company, the better. Attention to detail and all this stuff. There's a lot of stuff. But if you're diligent about taking a look at it before you pull the lever, so to speak, you'll be better off. So let's see. I think that covers everything. Now, one thing I have done here at the very end, there's some resources here that are just basic diligence checklists. And they are all over the map in terms of what you will see. For instance, I don't know if it'll work or not. I'm going to try it. This is one from the Angel Capital Association. And these folks are trying to help angel investors just like Angel NV. But you can see it's very, very extensive.
That's not what we're seeing.
You're not seeing it?
Mm-mm.
Oh, okay. Don't know why. I guess it doesn't work.
Well, we're gonna send out this deck
You'll
to
see,
folks.
yeah.
They can take their time looking at it.
Yeah. So
we do have some questions. Do you want to stop
Sure.
sharing and we can see your lovely face and you can answer these questions? And they're pretty varied.
Okay.
So the first question that I see here is it appropriate to be paying yourself a salary? And assuming it has to be a minimal amount to not scare investors. So don't talk for 20 minutes on this. Just give them 5.
I won't even go 5. I would say at an early stage, it's not a good idea to be paying yourself a salary. You probably don't want to start this business if you don't have the ability to do it full time and you have money in the bank where you can do that. If
For
you
what period of time?
Call it a year.
I would say 2, but okay.
Call it a year.
All right. Chris is saying, I've seen different terminology used in the marketplace. This actually doesn't have much to do with due diligence, but you can answer it. What is the difference between MVP, working prototype, and beta?
So MVP, minimal viable product, it means it's something that you're ready to present to the marketplace. The beta means you're taking that MVP and you're testing it in the marketplace. It's not launched per se. It means that you're out there testing it to see if there's modifications that need to be made, whether your customers are happy with it, do they want to see adjustments to it, that type of thing. And what was the other part of it?
Working prototype.
I'd call that about the same as a minimum viable product. I mean, it's similar.
Yeah, so during the beta phase, it's really important that you're talking to your customers and tweaking that product so that it becomes something that's really sticky, something that they can't live without. Your customers are the best ways to improve the product, but you have to be talking to them. You can't have a bunch of engineers sitting in a room and telling each other how great the product is. You need to talk to your customers.
Building it and expecting them to come is not the way to do it. That's what I said. Before you turn a code or you need to do your market research, which includes that customer. You have to go out there and really beat the path and make sure that what you're going to spend, a significant amount of time on is going to have some level of traction. You go to those potential customers and you say, well, if I had this, this, and this, what would you be willing to pay for it? Actually ask them. If a lot of people develop products with no discussion with customers and then they expect to launch it in the marketplace, and it doesn't work. Never has.
Okay, Ray is saying before revenue, the only valuation you can have is to test the app. It's either users growth and revenue growth. He's asking, is that correct?
Well, okay, so I guess it comes back to on the app, what are you trying to accomplish? What's it supposed to do? And what kind of metrics do you want to measure? But again, who's your audience for this app? What have you done with the customer? If you understand what your customer wants and the features that they want, you should then know what you need to measure their satisfaction in that app.
Okay, so for example, your app makes it easier to know what bird is in that tree. So you're going to talk to these birders and they're going to tell you half the time you're wrong. I point my phone at that bird and that's not the right bird. I know birds, you don't. So this app sucks.
Yeah.
So, but you only know that if you talk to your customers. Okay, so here is another question. I believe Douglas's question was about salary. Yes.
About what?
He was the one who asked the question about salary. So here is a follow-on question. Building on Douglas's question, does it make sense to get paid market value as a founder to fully onboard and work on this company full-time by having to leave a cozy corporate job? So this person wants to leave a cozy corporate job at X dollars and make the same amount at a startup, his startup.
If you're funding it yourself and you're going to pay yourself that salary, I suppose, but when you run out of money, what then? An investor likes to know there's sweat equity in there. Okay. And part of that is maybe the cash infusion you've put in, but it's your time and effort. If you're worried about leaving a corporate job, then maybe you need to reassess whether you want to do that startup. It's one of those things where you have to put 100% of your time into it, or it's going to fail or it's just not going to really get off the ground.
So Ray is saying over a period of time, say you raise $2 million from investors, that would be a form of your first valuation. Is that correct? So you've gotten investment of $2 million over time, and you're still developing your product. does that actually translate into what you could say your valuation is?
Yeah, because those investors, when they give you that money, they're making an estimate of what they think your company is worth, okay? And then the very early stages, it's a guess. Farther down the road, not so much. But yeah, there's a valuation somewhere in that thinking process to fund that company,
Okay.
even if it's multiple times.
And Chuck DeVita, who is he's an expert, and we're happy to have you here, Chuck. Thanks for coming. He's a Silicon Valley fella and does a series on sales at enterprise level. It's really intense. But he is mentioning that valuation done by entrepreneurs before Series A is not a very useful exercise. Your valuation is only based on what VCs will pay for a percentage of your company.
That's what I said.
Yeah, and that's why a SAFE is preferred, because there's no valuation until there's an event that causes a valuation to be settled upon.
Pretty much, yeah. The SAFE does anticipate, well, you can do it with or without a valuation cap. So on the one hand, it could. On the other hand, it doesn't have to. So the safes are there's several versions of them, even at the YC level.
Yeah, they have two. And I think their first one is harder to find now.
Yeah. But he's correct. At the VC level, it's how much do I want to own and what valuation supports it.
And that's the reason that they do due diligence, is to arrive at that number. So all of these records that you have for your sales and your expenses and your projections, that's why the VC will do the due diligence, is to try to arrive at what they think your valuation will be. And then you're probably going to have to negotiate on what the actual evaluation that you agree to is.
Yeah. Yeah. And that's going to determine how much you give up based on what they want. You as the founder decide whether you want to give up that much, but at the venture level, you're looking 15, 20%. Almost always.
Yeah. Chris is asking, how important is compliance and or regulatory bodies when talking with investors? Do investors care about these things?
Oh, yeah. Yeah. If you've got a medical product, they're looking at it saying, okay, what's it going to take to get through an FDA process? Have you planned that out in terms of how you're going to launch this product? Have you thought about how much it's going to cost, the time and effort to get that done? It's a long process and costs a lot of money. And if the product isn't something that, has a real draw in the market, more than likely it's going to be difficult to get funding because they don't think it'll get traction for the length of time it takes to get it approved. Also, whatever team that would manage that process is important as well.
Within the startup?
Within the startup, yeah.
Okay, somebody who is in person in Las Vegas is asking, how do investors feel about a founder working part-time elsewhere till they have savings, funding, legs, or is it better to wait to launch till capital ready to work full-time?
I've seen it both. I mean, the rub is at some point, you could do it part-time, but at some point the rub will be, you need to stop, you need to go full-time on it if you want to really gain traction. If it's a great idea, doing it part-time, you won't do it justice to get it off the ground in a good way. So you could do it that way. I think it's better off to be financially ready to go full-time and see what happens, but you can do it both. It's going to take you longer to do it.
So our founder from 2 weeks ago, Danielle, who has Outlaw Soaps, she had a very particular skill set. And so she was able to do these consulting jobs that didn't take a long time while her husband and the employees continued to work. And so she was helping to fund her startup through these consulting gigs that she would get. And she was not a murderer. Did you have a question over there?
Yeah, I kind of have a two-part question. So tying back to that, instead of paying yourself a salary, would you ever recommend a founder take an owner's draw if required, if they don't have enough capital to hold themselves over, like enough savings to hold themselves over for 2 years?
When you say that they take a what?
An owner's draw. So, I mean, I guess depending how
Where does the draw come from?
it would come from the profits of the company. So I guess that actually wouldn't work. And the second question being, would you ever recommend bootstrapping it for as long as you, or at least for a definite some amount of time, let's say 3 to 5 years, to gain some metrics to show to VCs to give you a better valuation?
Well, investors love bootstrapping because it shows that you're willing to put skin in the game.
But will that make you less competitive to, let's say, someone who's maybe working on the same project as you, but they're going up for funding immediately to?
I don't think so. It's really dependent upon, what your business is, what your product is.
Right.
That's where the competition lies.
Okay.
No one else?
No, there's more.
Oh,
So this one's a little bit involved. So this person is asking about a valuation regarding an MVP. So they've invested $125,000 on an app and a web portal, and now they've got them working on both iOS and Android. What's the best way to get funding to test it in beta?
well, I mean, if you've done the research on the market side, and it's extensive enough that you can convince an investor that this thing can gain some traction. In other words, it's something, maybe call it unique in the marketplace that doesn't exist. That's one way. But really, again, it boils down to if you haven't done the homework around before you turn a line of code, you're gonna figure out that eventually you don't know enough about your market and whether that product will sustain itself. It really requires, digging into the aspects of the marketplace and understanding, is there a need in the marketplace? Are you solving some problem that has to be solved? And it's so important that somebody's going to take it no matter what, because they have to have it solved. And that's your research. That's your customer research.
Okay, another person is asking, he feels like he needs business advice more than he needs money. Is it worth it to get an investor for their guidance and just pool the money for future needs, growth, marketing?
I suppose that's one method. I say the question because it was.
He's saying that he needs advice more than he needs money.
Well,
And so he wants to take advice from an investor. There's an adage in Silicon Valley, you ask for help, you get money. You ask for money, you get help. Okay, so
yeah,
ask for help. There are plenty of resources that are willing to give you help. You just have to make it interesting for them, and you can't be a pain in the ass about it.
yeah. And there's tons of resources out there to get help. All kinds, they're there.
Well, I do have a question. And that is, we have a drip irrigation hand tool that we've developed. And as far as doing customer research, one of the things that I did is I went to the World Agricultural Expo in California right before the pandemic. And they allowed me to show it to all the people there to see.
There was interest.
Everybody thought it was a great idea and all that. Now, the one thing I didn't do is ask how much would you pay for it?
Right.
And we've gone through, we contacted some contract manufacturers, domestic, and I'm looking at some foreign guys to look at making the tool to do that. Would that be a good approach, going to shows?
Oh, yeah.
Not as a carpetbagger, which everybody probably knows what it is, but basically just to get authorization to, show the hand tool.
Oh, yeah.
Went to the Irrigation Association too.
Yeah, I went to the.
And that's a good way to sell the VC too, saying.
Bill, can you repeat the question?
Yeah,
and the response?
he's asking, he has a tool And if he goes to, conventions or trade shows, things of that nature to present it, is that another way to assess whether the market is interested in that product? And it is. So long as they're your final customer, or if they think they have a need to distribute a product like that, because it depends on the level you're talking to. I don't know the level at the trade shows that you were talking to, whether those were the bottom line user or they were distributors or what.
It was a mix.
It was a mix. Okay.
But on another note, I went to Irrigation Association. They had it's called a fast pitch.
Yeah.
It was similar to the Shark Tank type of presentation. And, presented an earlier prototype to the 5 judges, and basically all of them said it was a great idea.
So is
Of
that,
course, we have a new prototype. I just brought it.
so is that some investors look at, like, you've been out there?
No, not really.
No.
I would say no, not really, because people are not going to be negative to your face. They're going to tell you what they think you want to hear.
Actually,
Sales makes the most impact.
Actually, at the Irrigation Association, they were rude to one guy's ideas. So in this case,
Yeah.
they were very honest. So
Okay, back to questions in the chat. Jonathan is asking for a definitive answer. He says, what I'm hearing is we need to do it full time, but not get paid to scare off investors.
Well, the investor, depending upon, what you think you need to economically survive, if that's coming out of the funding, especially in early stage, I would say when you hit the C+, the A level, they're not so concerned about that anymore. They expect to see some kind of salary. Early on, they're not really interested because it's smaller amounts going into salary, not essentially growing the business directly, not being used for things that are going to enhance the structure of that business where it's visible. That's the problem. Investors early on are not interested in seeing it diverted to salary or paying off debt for that matter, because I've seen, questions about that as well.
Yeah, so if you think of your pitch deck to these investors and you've got an ask slide in there, and you should be breaking down your use of funds. When you have a big percentage dedicated to salaries, it's an automatic turnoff. So they want to see that their money is going to growing the company, to either getting you to the next level in your development or in next level in sales.
Yes, I agree. So you said it all.
Okay, somebody's asking where they can find a list of resources to get help. They are all over the internet.
Mr. Google.
Yeah. Okay. Question concerning operating leverage. We have a little over 200,000 in contracts, which is great, in hand now that we intend to invoice Q4, Q1, with a realistic potential for about $1 million more through 2022. We expect GM to be about 50% on this early revenue, much of which is services. I don't know what he means by GM, like General Motors or something else.
Gross margin? No.
It's Charlie Maddox asking. Anyway, we expect our labor plus OPEX operating expenses to be about 1.25 million over the next 12 months or so, much in contractors with payments on deliverables. Materials cost of goods sold is negotiable at this stage, and our supply terms so far are favorable. What would be the best debt leveraging strategy, source or resource to use against receivables during the crucial next year period, 2022, when we will have bursty revenue? I think he means sporadic.
Without seeing.
And rapidly increased burn rate with contractors and payroll.
Yeah, without seeing it all, it's difficult to.
Yeah, that's a very involved question,
Yeah.
a little bit too
You
involved.
got
for
to
this
see all the
forum.
numbers to really
Yeah.
even understand it.
All right, another question about pitch decks. So groups, what decks that are 7 slides long, and there's groups that want 15 to 20 slides. What's an average deck size that has enough in the deck to get your point across?
12 slides. 12 slides, problem, solution, marketing, competition, your business model, some kind of traction, and your team.
And then the S. Okay, I'm sorry. So gross margin, GM was not General Motors. It was
Gross margin, okay.
So for the pitch decks, when you're doing a pitch, you need to know how long you have. So you have to cover the basic areas that Bill just mentioned, and you can do it in more detail the longer the amount of time that you have. But you need to cover all of those areas. And so there are future boot camps where we talk about pitch decks and TAM, SAM, SOM, and the things that you need to put together for that. So tonight's episode was all about due diligence. And I think that the major takeaway is organization. You need to be very organized. You have to stay on top of the deals that you're making really early on, because a lot of times people start a company and they don't know that it's going to be huge. And so they take money from Uncle Jack and they write it on a piece of paper. But you have to be keeping track of that. Let's talk for a minute about deal rooms. What are those?
Deal rooms?
Yeah,
Yeah, oh, you mean the data room?
yeah.
Yeah. So in order for an investor to start figuring out and going through the diligence items, let's say it's off of a checklist, you have to create what is commonly termed a data room. You could call it on Google Drive as an example, or Dropbox, whatever you want to use. And within that room, you're going to place all these different items that are on the checklist as best you can, whatever you have. And a rule of thumb, if in doubt, put it in there, because somewhere, somehow, a question will lead back to it, more than likely. But that's essentially deal room, data room. That's how it's done. And the reason why I would say Startup NV, FundNV, and Angel NV focus so much on this, because if you get this right the first time or second time, it may take some iterations. When you get down to that, that big venture deal, let's say, if that's your focus, you're prepared. You're not scrambling. You've done it before. It's already there. You know what to expect. And believe it or not, the investor is going to be a lot more impressed because he's not waiting around for something to show up. So it's the thing to keep in the back of your mind as you're doing these various things, contracts, etc. Create a file system so that when you need to, you can take it and put it straight right into your data room as part of the checklist that may be asked for. And one other thing I wanted to mention about marketing, this is where, from a financial standpoint, companies tend to spend a lot of money because they really don't understand, what does marketing really mean? That there's so many different aspects of marketing, and you can spend one heck of a lot of money hiring somebody and basically just doing what I call, or what I will quote a book, random acts of marketing. Do the research. There are a ton of ways to skin the cat. There are over 8,000 platforms out there, all trying to promote a product that helps with marketing. There's basic elements of marketing that you need to focus on, and it doesn't require you to go out and hire somebody. A lot of marketing firms will say, I'll build your website. You can do that yourself. You just need a landing page to start with. That's the basics. From there, as you build the corporation, that website evolves. But why pay somebody $5,000 to build a website? You can do it yourself, or there's platforms that'll build it for you with not a lot of money. It's things like that to pay attention to.
And that kind of dovetails into one of the other questions here. Does it scare investors if you issue equity to key advisors or board members? Is there a scale?
Yeah, okay. No, it doesn't scare, but the typical range that you will see for advisors, and there are contracts that you would have that would specify what they're providing you, yada, yada. But generally, 1/2 percent, say, up to 2% for somebody who's a rock star. Okay? But generally in the 0.5 to 1% range. And you will have had or should have had some really good conversations with them about what you expect in terms of their time. So many hours per week, let's say, or hours per month, or whatever. You need to make sure you've discussed that in advance. Just say, hey, you want to be an advisor? Do the diligence beforehand with them so they know what to expect and you know what to expect, and there's a meeting of the minds. Hope that wasn't overkill.
No, that was a good answer. Here's another question. When creating financial projections, is it better to look at industry comparables in a similar growth phase? Or is it better to base your growth assumptions on your current market research and the results of your beta testing?
I like the beta testing. If you're in beta and you're getting an inkling that there's let's say a fork where you need to go one way and the market is saying going this way, but your research or your feedback from your customers is indicating the stronger way to go is what you're getting out of your beta. Use that. You can temper it with some of the other market data, just to, see if it's reasonable. But I like the beta approach. As long as you're measuring properly, what it is you're getting out of that beta, you're looking at the right things, okay? Which again, you need to establish before you launch it. Don't figure out what you want to look at after you've launched. It's too late.
So, and you refer to that as a key metric.
Correct. KPIs, key performance indicators. You should have some idea of what you want those to be.
Okay, if you created an app and it has an algorithm and let's say starting day one creates a group of core users daily for the sake of discussion, 1,000 users each day, is that a good way to assess evaluation over a 30-day period, a 30-day process?
An algorithm that does what now? It has how many?
Okay, so what I'm gleaning from this, Ray, is that you have some patentable algorithm for your app, which gives you unique information. And you're saying you have a group of core users. Now, if they're using it daily and the number stays at 1,000, I wouldn't think that that's so hot. But if they're using it daily and you're growing your user base that wants to use it daily, that's a good thing.
Right. So to expound on that a little bit, when we talk again, the KPIs, what do you want to see? You want to see some kind of, if you're interested in users, you want to see some kind of growth. You want to set some kind of expectation. And if you're not meeting it, you got to figure out why. What's going on? Why didn't I get there? Same thing with sales. You set a certain target, and so that's the purpose of the KPIs, so that you can go back and figure out, okay, why isn't this working? What do I need to change?
Okay, he's saying the real projected number is 1.5 million users per day. He was just using 1,000 as an example. It seems like 1.5 million users per day, if they're spending a good amount of time on it, that's possibly a viable product. My question would be, how did you arrive at that projection? And how long do you anticipate it's going to take to get to 1.5 million users? It's really easy for founders to fool themselves and to create a number where it seems that would be a sustainable company. But I mean, once you start your beta, you're going to have actual data, and that is the most important thing.
Yep. And that actual data determines whether you're getting proper traction or not. You're going to find out, your users are going to tell you whether what you're giving them is something that they want or they need it modified, because it doesn't quite answer their problem.
And it's one thing also to just have users, but if those users aren't spending any money, then the company won't survive.
Yeah.
So there has to be a way to monetize all of that time spent on the app and the number of users that you have. So you have to look at that as well.
That just user count doesn't tell you much unless you know what's the business model? What do you could have a bunch of users and really all they're there for, kind of like a Facebook, eyeballs for advertising. That's user count, but for what? What are they accomplishing in your business?
Okay. Logan, do you have any more questions over there? Or online?
We don't.
Okay, well, thank you very much, Bill.
Mhm.
I really appreciate it. There was a lot of information here, and we'll be sending out with our follow-up email the link to the deck. And as far as it goes for some of the resources, you can email us and ask about resources. I don't have a compiled list of resources to send out to you. But if you're thinking of engaging with somebody and you're not sure, just run it by us. We don't know everybody, but we may be able to give you some feedback on that. Next week is our first pitch and pitch deconstruction session. So everybody's invited to do a 1-minute pitch on your company. And trust me, a 1-minute pitch is difficult. You have to write it. It's about 100 words. You have to practice it to get it done. And then what we're going to do is we're going to ask for a guinea pig who wants to go first. And they get to get immediate feedback. And for offering to be the guinea pig, they get to go again at the end. After that, we're just going to be going one by one by one by one. And we're going to have a few judges that are joining us, and they will give feedback as a whole, and they will let the first person go again. We're going to have a quick vote on who we want to hear more from. And so the prize for your 1-minute pitch is getting to do a 3-minute pitch. So if you want to do a 3-minute pitch, you can have slides for that one. So you should prepare, if you think you're that good, you should prepare a 1-minute and a 3-minute pitch with a couple of slides. For 3 minutes, you got maybe 3-4 slides, depends on how quickly you go through them. So that's what we're going to do. Let's see, for the 1-minute pitches, non-disclosure agreements assumed. Bill, would you like to handle that?
Handle which now?
LB Corney thinks that there are going to be non-disclosure agreements in place for a 1-minute pitch.
Why would you want to do that?
What can you tell anybody in 1 minute that needs to be on an NDA?
The thing to remember about investors, if they violate your confidence, they won't get any business anyway. Nobody will go with them as an investor. So, unless it's, something so highly technical that, you're worried about, a competitor or something, I don't think it's necessary.
I think you're right. I think that you all should understand that even with a 10-minute pitch, the goal of the pitch is to get to the next meeting. It's not to disclose all of your secrets. It's
Right.
just to get the next meeting. And then you're not going to open up your deal room to somebody before you already have an understanding of what's going on. Like, what are you after? Are you going for a $2 million investment? You're going to have some understanding. At that point, you may do an NDA, but most investors don't want to. They're not going to tell your story. And the person who thought maybe other people who were listening would be able within 1 minute to take an idea and run with it, just don't pitch. If you're that worried about it, don't pitch.
I would agree.
In the room, yes, sir.
Is this the same as what's referred to as an elevator pitch?
An elevator pitch is usually about 2 minutes, so it's even shorter than that.
Okay.
Okay, so that'll be same bat time, same bat channel, 5:30 next Tuesday. It may go a little bit longer, depending on how many participants we have and how many people are willing to do their 1-minute pitch. Then we're gonna have about 10 minutes for the voting, And then we'll go into 3 people will get to do a 3-minute pitch. So you should be all queued up and ready to go with your slides if you do say that you're willing to be put in the voting for that. Thank you, everybody. We'll see you next time. Yes, everyone can pitch. Everyone is encouraged to.